Good afternoon, Ken at Tortoise Capital with a review of the weekend trading report for January 25th, 2020. Bullish normal conditions. We've had pullbacks here on the 3, 10, and 30-day look back, still long and strong. Green bullish on strength relative to the 200. The ADX14 still powerful bull at 39. Risk Z is in the risk on condition with a score of 1.32. That's a risk Z of 0.21. You can see that we're hovering near the zero line, so we're more vulnerable to volatility spikes and short-term pullbacks now, which we're starting to see creep in. You can see the holdings for blended monthly rebalancing for the rest of January, and the leaders in the different categories and portfolios based on Friday's close. ETF2 remains at 100% exposed in the theoretical model. Doing some great work with that TC2000 bundle. Check it out. Danny's added a number of case studies that show it live and in action, and the folks that are using it for swing trades and sector rotation and rapid framing are reporting excellent results. Monthly market health check. I want you to notice the pinch and then the expansion here, and here. This was the second leg of expansion up. This is where it could have collapsed into the Bollinger Band mean, but it found support and then resumed the second leg up. We are in the summer in the four seasons, I should say. Still a strong monthly candle. And you see these support levels at the 1 month, 2 month low, the edge of the dragon, the belly of the dragon, the PSAR, and the Bollinger Band mean are about at the same location, and then fair value on a monthly basis down here. Everything above monthly fair value is a measure of the strength of the Trump economy. Weekly basis, zooming in a little bit more again, you have the pinch and then the expansion. Still expanding. Weekly high, weekly low, and 2-week low. Belly of the dragon, PSAR, fair value, Bollinger Band mean, and the RL90. So a nice cluster of support around 310. C minus 1, 2, and 3. And then the 200-week moving average, and we are solidly in the summer on the weekly health check. Daily health check had a sell-off on Friday, which found support at the edge of the dragon and the PSAR. All-time high here. The Z1 height, and then en route to Z3. Potential target at 336. These are places where I would add additional. Daily low, 10-day low, Bollinger Band mean, fair value at the RL 270, and then Z minus 1. We are in the fall and just entering the Red River, so pullbacks to 324 would not be unusual. That would be the least surprising move. Mixed bag this week. Treasuries and real estate, the defensive plays had some traction. Utilities, defensive play, the treasuries again. But the winners were relatively solid. Technology in the S&P held up pretty well. In the Dow, Intel with some amazing earnings, American Express and financials, and looking for more strength on this turnaround in McDonald's. There's an interesting swing trade going on in there. Collapsing in Caterpillar and Merck, so we'll be framing those as potential sell-off candidates. In the sectors, home builders, utilities, treasuries, and real estate, so all the defensive plays receiving some of those excess gains, I believe, this week. Among the leaders, I would just say that only technology really held up very well at all. ETF Max, The winners had some micro gains, and all these tend to be in the technology and defensive play sector. U.S. remains mostly above average, with technology large caps really doing very well. Winners continue to win. Russia, Vanguard Growth, and the S&P Growth all have the green and white, so that's was good, now great. So looking to exploit new strength, new leaders emerging there. Things that are white and green were great, now just good, so you want to be preserving profits and watch for resumption in things like this market vectors, Taiwan, biotech, and equally weighted NASDAQ. Shifting to the daily, a number of candidates for channeling and overreaction. We'll be framing those on the long side, looking for evidence of gains, but those would be the first ones to look at getting short should this sell-off continue. Max Payne has some blue chip choices in there: Merck, Morgan, Caterpillar, Mobil, and Walgreens. Merck at 2.4 and Dow at 2.4 to 1 on the auto framer. Lots to choose from in here. ExxonMobil, 5DD, and a Doji, and has been among the weakest of all. Big gains and breakouts in Intel and American Express. You can see the magnitude of those gains, and these reds were all breakdowns of the look-back period's trading range. So this sell-off harshly in Merck was a big deal. In the ETFs, a handful of channelings, I should say. Emerging markets looks interesting. It's a channeling. It's an overreaction long. It's also a Max Payne range compression with a 2.3 to 1 reward to risk ratio. Breakouts in treasuries and utilities. That one should be of concern to long side equity folks. Lots to choose from among the super pinches. Auto framer showing us some mechanical entry and trade frames that have very favorable reward to risk ratios in here. Things that jump out at me: Disney and Morgan, Dow, Caterpillar, Merck, Chevron. The whole energy complex is in there. Travelers leading the way at 5 to 1. You see the Four Seasons of MACD on the daily, and then some more specific breakdown by category here. I like looking at the springs, so I'll be taking a look at Verizon and U.S. Steel. The NDX multi-time frame is sorted by the 10-day NDX. See the big breakdowns in here: Merck, Walgreens, Morgan, financials, oil, and so forth. And then big breakouts and the defensive plays in the ETFs, and then the particular candidates are American Express and Intel and the Dow. So I'll be framing those. This gives me insight into rapid opportunities with my friend the Coyote and Golden Jackal over there. First big crack in the index's upward movement, coinciding with the flu virus and the impeachment shenanigans. And this is also a logical breakpoint for the percent stretch. I mean, we've gotten 2 sigma above. Now, the slope of the 30 was at a place where it has rolled over historically, as we mentioned last week. So this is the least surprising behavior of all. And this crossover over its own 10-period moving average, 1 standard deviation above average, is we would interpret that as a strong possibility of a swing trade reversal moment right in here. If that's the high, then it's going to come back in here to about 320. just how strong this last quarter's move has been. Those rising highs and the very strong upward slopes. And just a little bit of volatility starting to creep back in. The slope of the 90 is extreme. The 30 has rolled over, the 10 rolled over at logical points. So one leg, pause, two legs, pause, then a breakdown to get it back to 320 would just be the bottom of the river. That would be, again, the least surprising, coming back into this congestion zone. And just flash through these for your reference if you want to stop and review. So, lots to choose from this week. Preserving gains, framing shorter-term opportunities, watching those defensive plays, technology, real estate, treasuries. Those are the keys. And the energy sector, of course. That's Ken at Taurus Capital. Keep your risk measured and your powder dry.